Before we begin, please note that the information provided in this video is for educational and informational purposes only. I am not a licensed insurance agent or financial advisor. The content of this presentation is not intended to be a substitute for professional advice. You should always consult with a qualified and licensed professional before making any decisions regarding your insurance coverage. Your individual needs and circumstances are unique, and the strategies discussed here may not be suitable for your situation. You get that letter in the mail. You know the one. It's from your car insurance company. Your hands get a little clammy as you tear it open, because you just know it's not good news. And there it is, in black and white, your premium is going up. Again, by 20, 30, maybe even 40%. For no reason. You haven't had an accident. No tickets. Your car is a year older. So what gives? You feel powerless, frustrated, and frankly a little ripped off. You're not alone. Right now, millions of Californians are feeling that exact same sting. But what if I told you that you are likely overpaying for your car insurance by hundreds, if not thousands of dollars every single year? And what if I told you that getting that rate down isn't about luck, it's about having a system? That's exactly why I created this series. This isn't just another video with a few generic tips like drive less or raise your deductible. This is a complete 10-part masterclass on how to navigate the absolute maze that is the California car insurance market. We are going to pull back the curtain and expose how insurance companies actually calculate your rates here in the Golden State, which by the way is completely different from almost every other state in the country. I will show you the hidden discounts you're probably missing, the common mistakes that are costing you a fortune, and the exact strategies to use when you shop for quotes to get the lowest possible price every single time. By the end of this series, you won't just buy car insurance. You will master it. You will be in control, not the insurance company. You'll have a rock-solid policy that fully protects you for a price that doesn't break the bank. So why is this so critical right now for every single driver in California? Because we are in the middle of a perfect storm. You've seen the headlines. Major insurance companies are pausing new policies, others are drastically limiting their business, and almost all of them have been approved for massive rate hikes. The cost of repairs has skyrocketed due to inflation and supply chain issues. The frequency and severity of accidents are up. All of this is creating a hard market, which is industry speak for, it's about to get really, really expensive for you. In this environment, just letting your policy auto-renew without shopping around is like willingly lighting a pile of money on fire in your driveway. The old rules no longer apply. The strategies that worked 5 years ago are obsolete. To survive and thrive in California's new insurance landscape, you need a new playbook. And this is it. Let's start by demolishing the single biggest, most expensive myth in the entire insurance industry: the loyalty myth. We've been conditioned to believe that loyalty is rewarded. Stick with a company and they'll take care of you, right? Wrong. In the world of car insurance, loyalty is often penalized. Insurance companies love loyal customers because loyal customers don't shop around. And customers who don't shop around are the easiest ones to hit with gradual, year-after-year rate increases, a practice sometimes called price optimization. They are betting on the fact that you're too busy, or that the process is too confusing for you to bother looking elsewhere. They might give you a tiny loyalty discount of 5 or 10%, while simultaneously increasing your base premium by 20%. It's a shell game. The truth is, the very best rates are almost always reserved for new customers. They call them acquisition rates. Insurers are willing to offer a fantastic deal to get you in the door, hoping you'll become one of those loyal customers they can slowly raise prices on over the next few years. That's why the single most powerful tool you have as a consumer is your willingness to switch. You should be shopping for your car insurance at least once a year, every single year without fail. It's the only way to keep the companies honest and ensure you're not the one subsidizing the discounted rates for their brand new clients. Now, to truly understand how to get the best deal, you have to understand what makes California so unique. It all comes down to a voter-approved initiative from 1988 called Proposition 103. You don't need to know all the legal details, but you must understand its core principle, because it dictates everything. Before Prop 103, insurance companies could basically charge whatever they wanted based on almost any factor they chose. After Prop 103, the state mandated that car insurance rates must be based primarily on factors that are within a driver's control. This was revolutionary, and it makes California fundamentally different from states like Texas or Florida. For example, in most other states, your credit score is a massive factor in determining your premium. If you have a poor credit score, you'll pay a fortune for insurance even if you're a perfect driver. But in California, thanks to Prop 103, using your credit score to set your insurance rate is illegal. They can't do it. The same goes for many other socioeconomic factors that are often used elsewhere. So, if they can't use your credit score, what do they use? Prop 103 established a mandatory hierarchy of rating factors. The law says that 3 factors must be given more weight than any others, in this specific order. These are the holy trinity of California car insurance. Number 1. Your driving safety record. This is your history of accidents and traffic violations. It is, by law, the single most important factor. A clean record is your golden ticket. Number 2. The number of miles you drive annually. The less you drive, the less risk you represent, and the lower your premium should be. And number 3. Your years of driving experience. The more years you've been licensed, the more predictable and less risky you are in the eyes of the insurer. These 3 factors, your record, your mileage, and your experience, form the foundation of your premium. Everything else, like the car you drive, where you live, and the coverage you choose, is secondary. Why is this so important? Because it tells you where to focus your energy. You can't change your years of driving experience, but you can control your driving record, and you can be brutally honest and accurate about your annual mileage. So many people just guess a number like 12 or 15,000 miles a year, when in reality, especially if they now work from home, they might only be driving 6 or 7,000. That difference alone can translate into a savings of hundreds of dollars. Understanding this legal framework is your first and most critical advantage. You're no longer just a consumer at the mercy of a black box algorithm. You now know the primary rules of the game, and we're going to use those rules to your advantage throughout this entire series. In the parts to come, we're going to do a deep dive into each crucial element. We'll break down exactly how to read your current policy line by line so you know what you're actually paying for. We'll dissect the difference between liability, collision, and comprehensive coverage, and I'll give you a framework for figuring out the exact right amount for your specific car and financial situation, so you're not overpaying for coverage you don't need or, even worse, dangerously underinsured. We'll uncover a list of more than a dozen hidden discounts that most agents will never volunteer, but that you are legally entitled to if you qualify. We will walk through the entire quoting process step by step, including the online tools you should use and the exact questions you need to ask a live agent to corner them into giving you their absolute best price. But before we can do any of that, we have to start with the document that holds all the secrets to your current rate. It's called your declarations page, and 99% of drivers have no idea how to properly read it. It is the key that unlocks everything, and in the very next part we are going to decode it together. Go ahead, grab it. Find your most recent car insurance bill and pull out that 1 or 2 page document. It might be attached to the bill, or you might have to log into your insurance company's website to download it. This is your declarations page. This is your personal cheat sheet to the entire insurance game. For the next few minutes, we're going to treat this piece of paper like a treasure map, because hidden inside these lines of text and confusing codes is the exact location of hundreds, maybe even thousands of dollars in potential savings. First, let's be clear on what this document is. It's not just a summary. It is the legally binding summary of your contract. It is the proof of what you are paying for. When you get a quote from another company, this is the document you'll use to make a true apples-to-apples comparison. Without it, you're just guessing. Let's start at the top. The first section is what I call the who, what, and when. It seems basic, but mistakes here are shockingly common and can cost you dearly. You'll see the policy number, the effective dates of your policy term, usually 6 or 12 months, and your name and address. Check that address. Are you still living there? If you've moved even just across town and haven't updated this, you could be paying a rate based on your old zip code. In California, your location is a massive factor in your premium. You might be overpaying, or worse, you might be underpaying, which could lead to your policy being canceled if the insurance company finds out. This is a silent killer of good rates. Next, you'll see the listed drivers and vehicles. Look at every name. Is everyone who regularly drives your car listed? If your teenager just got their license and isn't on here, you are playing with fire. One accident and your claim could be denied, leaving you on the hook for everything. Conversely, is there an ex-spouse or a roommate who moved out years ago still listed as a driver? Get them off. You're likely paying extra for them. Now look at the vehicles. Check the vehicle identification number, the VIN. Make sure it matches your car. A single digit being off could mean you're being rated for a completely different, more expensive model. It happens more than you think. Okay, that was the warm-up. Now we get to the heart of the map, the section that trips up almost everyone: your coverages. This looks like a wall of text and numbers, but we're going to break it down into simple, understandable pieces. The very first thing you'll probably see is bodily injury and property damage liability. This is the most important coverage on your entire policy, but here's the secret. It has absolutely nothing to do with you or your car. This is insurance for the other person. It pays for their medical bills, their lost wages, their pain and suffering, and the cost to repair or replace their car if an accident is your fault. On your page, you'll see it written as 3 numbers like 15/30/5 or 100/300/50. This isn't a secret code. It's a simple formula. The first number is the maximum amount. In thousands, your policy will pay for any one person's injuries. The second number is the maximum it will pay for all injuries in a single accident, no matter how many people are hurt. And the third number is the maximum it will pay for property damage. That's their car, their mailbox, their storefront, whatever you hit. Right now, I want you to look at your numbers. If you see 15/30/5, you have the California state minimum. I'm going to be brutally honest. This is financial Russian roulette. $15,000 for an injury? That can be wiped out by a single ambulance ride and a few hours in the emergency room. $5,000 for property damage? The average new car in America costs over $48,000. If you tap the bumper of a new Tesla or a BMW in traffic with state minimum coverage, you've already exhausted your policy limit before the tow truck even arrives. Every dollar above that $5,000 comes directly out of your pocket. Your savings. Your paycheck. They can and will garnish your wages for years. State minimum coverage doesn't protect you. It just makes you legal to drive. It protects everyone else from you, but only barely. Okay, moving down the list. The next two are a team. Uninsured and underinsured motorist coverage. You'll often see them abbreviated as UM and UIM. If liability is for when you hurt others, this is for when a lawbreaker hurts you. California has one of the highest rates of uninsured drivers in the country. Some estimates say as many as 1 in 7 drivers on the road have no insurance at all. If one of them hits you, their non-existent insurance isn't going to pay for your medical bills or fix your car. That's where this coverage steps in. It pays for your injuries, your passengers' injuries, and your lost wages when the at-fault driver has no insurance or not enough insurance to cover your costs. It essentially takes the place of the other guy's liability coverage. Many people decline this to save a few bucks a month, but it is one of the most critical protections for your own family's well-being. Next up, you might see medical payments or MedPay. Think of this as good faith money. It's a small bucket of coverage, usually $1,000, $2,000, or $5,000, that pays for initial medical expenses for you and your passengers, regardless of who is at fault for the accident. It's designed to be fast. It covers the ambulance, the ER visit, the health insurance copays, without waiting for a lengthy fault investigation. It has no deductible and it follows you. If you're hit by a car as a pedestrian or a cyclist, your MedPay can still cover you. Now we get to the two coverages everyone knows: collision and comprehensive. These are the only two on this list that are primarily designed to fix your car. Collision is simple. It pays to repair your vehicle after you collide with another car or an object, like a pole or a guardrail. Pays out whether it was your fault or not. Comprehensive is for almost everything else. Think of it as the acts of God and chaos coverage. It's for theft, vandalism, fire, hail, a rock cracking your windshield, or a tree branch falling on your roof. Next to both collision and comprehensive, you'll see a dollar amount. This is your deductible. The deductible is the amount of money you agree to pay out of pocket for a repair before the insurance company starts paying. If you have a $1,000 deductible and the repair costs $5,000, you pay the first $1,000, and the insurance company pays the remaining $4,000. Here's the key. A higher deductible means a lower premium. Raising your deductible from, say, $250 to $1,000 can save you a significant amount of money on your bill. It's a trade-off between your monthly payment and your out-of-pocket risk. Finally, scan to the bottom of your declarations page. You should see a section for discounts. This is the treasure. Read every single line. Are you getting a multi-policy or bundling discount for having home or renter's insurance with the same company? Are you getting a good driver discount? A good student discount for your kid? A discount for setting up autopay? Companies have dozens of these, but sometimes they fall off at renewal or were never applied correctly in the first place. If you see a discount you think you qualify for but isn't listed, circle it. That's a phone call you need to make. That's found money. Take a step back and look at that page now. It's not just a bill anymore, is it? It's a blueprint of your financial protection. You now know how to read the code. You know what each part of your policy actually does. You can see where you're strong and, more importantly, where you might be dangerously exposed. You've decoded the map. But now comes the most important part. You know what you have, but is it what you need? How much liability is actually enough to protect your house and your savings? Should you carry a $500 or a $1,000 deductible? Are you paying for coverages you don't even need on an older car? In the next part, we stop being students and start being architects. We are going to build your perfect policy from the ground up, finding that sweet spot between ironclad protection and the lowest possible price. Let's start with the foundation. Every policy, every single one in California, is built on a non-negotiable bedrock called liability coverage. This isn't insurance for your car. This is insurance for your mistakes. It's the "I'm sorry I dented your brand new Mercedes" fund. It's the "I'm sorry I caused that fender bender that gave you whiplash" fund. More importantly, it's the one thing standing between a simple accident and a lawsuit that could vaporize your savings, your investments, and even your future earnings. In California, the law says you have to have it. But here's the first critical secret most people don't understand. The legal minimum is a trap. It's a financial landmine waiting to go off. The state minimums are ridiculously low. $15,000 for injury to one person, $30,000 for injury to multiple people, and just $5,000 for property damage. Let me say that again. $5,000 for property damage. What can you buy for $5,000 in a collision? Maybe a new bumper on a luxury car. Maybe what happens when you rear-end a brand new Tesla, a Rivian, or even just a normal F-150, and the repair bill is $20,000, $30,000, or $50,000. The insurance company pays its $5,000, wishes you the best of luck, and you are personally on the hook for the rest. They will come after you. They will garnish your wages. That one moment of distraction on the 405 could financially haunt you for a decade. So we're not building a shack on a foundation of sand. We're building a fortress. Your liability limits are typically shown as 3 numbers, like 15/30/5. The first number is bodily injury per person, the second is bodily injury per accident, and the third is property damage. Forget the state minimums. For a person with any assets at all, a home, a savings account, a 401k, you should be looking at a bare minimum of 100/300/100. That's 100,000 for one person's injuries, 300,000 total for all injuries in an accident, and 100,000 for property damage. This is the new starting line. It often costs just a few dollars more per month than a weaker policy, but the difference in protection is astronomical. It's the cheapest peace of mind you will ever buy. Okay, the foundation is poured and solid. We've protected our life from a catastrophic lawsuit. Now let's build the walls. Let's protect the car itself. This is where collision and comprehensive coverage come in. People mix these up all the time, but it's simple. Collision covers damage to your car when you hit something. Another car, a pole, a curb, a wall. If you are at fault, this is the coverage that fixes your car. Comprehensive covers almost everything else. Think of it as acts of God or acts of chaos. A tree branch falls on your hood during a storm. Your car is stolen. A rock flies up on the freeway and cracks your windshield. Vandals key your door. Hail damage. Fire. These are things that aren't your fault, and they aren't a traditional collision. Now here's the key question. Do you need them? If you have a loan or a lease on your car, the answer is yes. Your lender will require you to have both. But if you own your car outright, it's your call. And the decision comes down to a simple formula. The value of your car versus the cost of the coverage. If you're driving a 15-year-old beater worth maybe $2,000, and your collision coverage costs you $600 a year with a $1,000 deductible, you're paying a fortune for a tiny potential payout. You're better off self-insuring, banking that money instead and accepting the risk. But if you're driving a car worth $10,000, $20,000, or $50,000, going without collision and comprehensive is a high-stakes gamble. Could you afford to write a check tomorrow to replace that car if it were totaled? If the answer is no, you need these coverages. When you add these, you'll be introduced to their best friend, the deductible. This is the amount of money you pay out of pocket before the insurance company pays a dime. Deductibles usually range from $250 up to $2,000 or more. And here's a lever you can pull to immediately affect your price. A higher deductible means a lower premium. Think of it as your share of the risk. If you choose a $1,000 deductible instead of a $500 one, you're telling the insurance company, "I'll handle the small stuff." In return, they give you a better price. The sweet spot for most people is a deductible you can comfortably afford to pay on a bad day without wrecking your budget. For many, that's $500 or $1,000. So our foundation is strong, the walls are up. We have a structure. Now we need a roof and a security system to protect us from the outside world. This brings us to the single most important and criminally underrated coverage you can buy in California: uninsured and underinsured motorist coverage, or UM/UIM. Listen closely. California has one of the highest rates of uninsured drivers in the entire country. Estimates suggest that 1 in every 6 or 7 drivers on the road with you right now has zero insurance. Let that sink in. That person who just cut you off, they might have nothing. If they slam into you and put you in the hospital, their non-existent insurance policy isn't going to pay for your medical bills, your lost wages, or your pain and suffering. You're left holding the bag. That's where uninsured motorist coverage saves you. It steps in and acts as the insurance the other driver should have had. It pays for your injuries, your passengers' injuries, and your recovery. Underinsured motorist is similar. It kicks in when the at-fault driver has insurance, but their pathetic state minimum policy runs out before your bills are paid. Here is the pro tip. You should always match your uninsured motorist limits to your own bodily injury liability limits. If you chose 100 of 300 for yourself, you should get 100 of 300 for UM/UIM. You are basically saying, "I believe I deserve the exact same level of financial protection that I'm willing to provide to someone else." It is bafflingly inexpensive for the monumental protection it provides. Do not skip this. Do not cheap out on this. It is the security system for your financial house. Okay, our fortress is built. It's secure. Now it's time to furnish it and turn on the utilities. These are the add-ons, the extras that make life easier after an accident. First up is medical payments, or MedPay. This is a simple, no-fault coverage. It helps pay for medical expenses for you and your passengers after an accident, regardless of who was at fault. It's great because it pays out quickly, without waiting for a big settlement. It can cover your health insurance deductible, co-pays, or things health insurance might not cover, like an ambulance ride or dental work. Do you need it? If you have excellent health insurance with low deductibles, you might only need a small amount, maybe $1,000 or $2,000. If you have no health insurance or a high deductible plan, MedPay becomes much more valuable. Next is rental reimbursement. If your car is in the shop after a covered claim, this coverage pays for a rental car. It's usually sold in tiers, like $30 a day for up to 30 days. To figure out if you need it, ask yourself a simple question. If my car is gone for 2 weeks, do I have another way to get to work? Can I rely on a spouse's car, public transit, or work from home? If the answer is no, and you can't afford to pay a few $100s out of pocket for a rental, then this coverage is a must-have. It's usually very cheap. Finally, there's roadside assistance or towing. This covers you for the basics: a flat tire, a dead battery, running out of gas, or needing a tow to a nearby mechanic. But here's the warning. Check to see if you're already paying for this somewhere else. Do you have AAA? Does your credit card offer a roadside assistance perk? Does your new car's warranty include it? There's no point in paying for the same service 3 times. If you don't have it anywhere else, it can be a convenient, low-cost addition to your policy. And there it is. We've just built a complete, intelligent auto insurance policy from the ground up. The liability foundation, the collision and comprehensive walls, the uninsured motorist roof, and all the furnishings inside. You are no longer just a buyer, you are an architect. You understand what each piece does and, more importantly, why you need it. But knowing what to build is only half the battle. Now we have to find someone to build it for the best possible price. This is where the game truly begins. You've designed your perfect policy on paper, a fortress of financial protection tailored to your life. But a blueprint is worthless until you find the right contractor to build it at a price that doesn't break the bank. And when you step into the insurance marketplace, it feels less like a hardware store and more like a chaotic, screaming bazaar. You've got geckos, generals, and friendly neighbors all yelling at you, promising the best deal, the fastest service, the lowest price. It's overwhelming. It's designed to be. Confusion leads to quick, uninformed decisions, and that's where they make their money. But we're not going to let that happen. We're going to cut through the noise with a clear, methodical strategy. There are essentially 3 ways to buy car insurance in California, 3 different doors into this marketplace. Understanding them is the key to not getting lost. The first door is the one most people think of today, the direct-to-consumer insurer. These are your Geicos, your Progressives, your Esurances. You go directly to their website, or you call their 800 number. You are dealing with the insurance company itself with no middleman. The big selling point here is speed and convenience. You can get a quote in 15 minutes sitting on your couch in your pajamas. Because they don't have to pay commissions to a massive network of local agents, their overhead can be lower, and sometimes that savings gets passed on to you. But there's a catch. When you go direct, you are the expert. There's no one to guide you, no one to ask, "Hey, does this make sense for my situation?" You're on your own navigating their system. And more importantly, you're only getting one price. Theirs. To compare, you have to go to the next website and the next, re-entering your information over and over again. It's like wanting to buy a new smartphone and having to drive to the Apple store, then the Samsung store, then the Google store, hearing a separate sales pitch at each one. The second door is the captive agent. Think of your classic State Farm, Allstate, or Farmers agent with an office on Main Street. These agents work for one and only one company. They are captive to that brand. The advantage here is the personal relationship. A good captive agent gets to know you, your family, your cars. They can offer advice based on a deep, almost encyclopedic knowledge of their company's specific products, endorsements, and internal rules. When you have a claim, you have a specific person to call, a face to a name, which can be incredibly comforting in a crisis. The downside is right in the name. They're captive. They can't sell you a policy from any other company. If their company's rates for someone with your profile happen to be high that year, their only tool is to try and adjust the coverage to make the price fit. They can't turn to their computer and say, "Well, it looks like Nationwide or Mercury could beat our price by $500 this year." They work for the company, not for the marketplace. The third door is the independent agent or broker. This is your personal shopper. An independent agent doesn't work for any single insurance company. Instead, they have appointments or contracts to sell policies from multiple different carriers. They work for you, the client. You go to them once, give them your information, and they go out and shop the market for you, bringing back quotes from 5, 10, sometimes 15 different companies. This is by far the most efficient way to get a wide range of quotes. Good independent agents are also experts in the nuances of the California market. They might know which company is friendliest to drivers with a ticket, which one gives the best rates for classic cars, or which one has a new, aggressive price point in your specific zip code. The potential drawback? They don't represent every single company. For instance, most independent agents can't give you a quote from Geico or State Farm. Also, their expertise can vary. A great one is worth their weight in gold. A lazy one might only check 2 or 3 companies and call it a day. So you have 3 doors: the DIY door, the company store door, and the personal shopper door. Which one do you choose? The answer is you don't choose one. You use all 3. This is the strategy one call the 3-pronged attack, and it is the single most effective way to guarantee you're seeing the whole picture. Here's how it works. First, you pick 1 or 2 of the big direct insurers and get a quote online. Go to Geico or Progressive's website and run the numbers yourself. This gives you a baseline. It shows you what the low overhead direct-to-consumer market looks like for you. Second, you call a captive agent. Pick a big one like State Farm or Allstate. Talk to a local agent. This gives you a feel for what a major full-service insurer can offer. Their price might be higher, but they might also present a different perspective on coverage that you hadn't considered. Third, and this is crucial, you find a well-regarded local independent agent. Ask a friend for a referral or look for one with great online reviews. Give them your information and let them do the heavy lifting of shopping the rest of the market. Those companies you've maybe never even heard of like Mercury, Kemper, or Travelers, which are often incredibly competitive in California. By using the 3-pronged attack, you've effectively covered all your bases. You've sampled the direct market, the captive market, and the broad independent market. It is virtually impossible for a truly great deal to slip through the cracks of that net. But before you can launch this attack, you need to prepare your arsenal. You cannot go into this process disorganized. The insurance companies are counting on it. You need to have all your information ready, accurate, and consistent. This is your pre-flight checklist. First, your driver information. Have the full name, date of birth, and driver's license number for every single person who will be listed on the policy. Second, your vehicle information. You need the year, make, and model of every car. But what you really want is the VIN, the vehicle identification number. The VIN is the car's fingerprint. It allows the insurance company to know everything about it, from its engine size to its safety features. It ensures the quote is 100% accurate for that specific vehicle. You can find it on the driver's side of the dashboard, visible through the windshield, or on the sticker inside the driver's door jamb. Third, your driving history. Be honest about any tickets or accidents in the last 3 to 5 years. Don't try to hide anything. They are going to pull your driving record in a report called a CLUE report, which details all your past insurance claims. If you lie and they find out, they can deny your application or, worse, cancel your policy after it's already started. Honesty up front saves you a world of headaches. Fourth, your mileage. Make a realistic estimate of how many miles you drive each car per year. This is a huge rating factor in California. Don't just guess. Think about your daily commute, weekend trips, and errands. And finally, the most important tool in your entire arsenal, your secret weapon. You need to have a copy of your current insurance policy's declaration page. This is usually the first 1 or 2 pages of your policy packet. It is the Rosetta Stone of your insurance. It lists every coverage you have, every limit, every deductible, and every vehicle and driver on your current policy. This single document is your blueprint. Because now we come to the golden rule of shopping for car insurance. You must compare apples to apples. This is non-negotiable. It is the only way to know if you're actually getting a better deal. When you get a quote from Geico, and then from a State Farm agent, and then from an independent agent, you must give them the exact same set of instructions. You hand them your declaration page, your blueprint, and you say, "Quote me for this." Exactly this. You don't want one company quoting you on California's bare minimum 15/30/5 liability limits, while another is quoting you on the 100/300/100 limits we talked about earlier. The price difference will be enormous, but it will be meaningless. You can't compare a shack to a mansion and say the shack is a better deal because it's cheaper. You're getting bids on the fortress you designed, the same liability limits, the same uninsured motorist limits, the same comprehensive and collision deductibles. Everything must be identical. Only then can you line the final prices up side by side and see who the true winner is. With your pre-flight checklist complete and your declaration page in hand, you are no longer just a shopper at the mercy of the bazaar. You are a general contractor, armed with a precise blueprint, soliciting bids from qualified builders. You control the conversation. You dictate the terms. You are comparing them, they are not confusing you. This is how you find the best builder for the best price. But getting these initial apples-to-apples quotes is just the starting point. The price they first give you is almost never the final price you should be paying. Because now we have to talk about the real magic in lowering your premium discounts. And there are dozens of them. Some are obvious, but many are so hidden, so obscure, that most people never even know to ask for them. And that's exactly what we're cracking open next. The complete list of California car insurance discounts that you cannot afford to miss. Think of the world of car insurance discounts not as a simple checklist, but as a video game with hidden levels and secret cheat codes. The insurance companies publish the easy levels, the ones everyone knows about. But the real savings, the ones that separate a good rate from an unbelievable one, are hidden in the game's code. You just need to know the right buttons to press. Let's start with what I call the Big Four. These are the discounts most people have heard of, but they often misunderstand the nuances, especially here in California. First up is the most powerful discount in the entire state, the Good Driver Discount. Now, this isn't just a nice little bonus from your insurer. It's California law. Proposition 103 mandates that insurance companies must offer at least a 20% discount to drivers who meet the Good Driver criteria. So what are they? 1. You've been licensed for at least 3 consecutive years. 2. In the last 3 years, you have not had more than 1 point on your driving record. And 3. In the last 10 years, you have not been convicted of a serious DUI or a similar offense. If you meet these criteria, you are legally entitled to a base discount of 20%. This is your starting line, not the finish line. If you're not getting this, you need to find out why immediately. It's the single biggest price lever in the state. Next is the multi-car discount. Simple concept. You insure more than one vehicle with the same company, you get a discount. But here's the pro tip. The vehicles don't always have to be owned by you. If you have a roommate or a partner you live with, even if you're not married, many companies will let you bundle your policies to get this discount. It's always worth asking about the specific household rules. The third of the Big Four is the multi-policy discount, often called bundling. This is where you have your car insurance and your homeowners, renters, or even life insurance with the same company. The savings here can be massive, sometimes up to 25% on both policies. This is the discount insurance agents love to sell because it locks you into their ecosystem. But don't let that scare you. If the math works, the math works. The key is to make sure the bundled price is actually cheaper than getting the best in class for each policy separately. Sometimes it is, sometimes it isn't. You have to run the numbers. And the fourth is the classic good student discount. If you have a driver on your policy who is in high school or a full-time college student and they maintain a B average or better, typically a 3.0 GPA, they can get a significant discount. But here's the lesser-known cousin of this discount: the student away at school discount. If your child is on your policy but they're attending college more than, say, 100 miles away and they didn't take a car with them, you can get a huge rate reduction. The company knows the risk of that student driving is now practically zero for most of the year, and they reward you for it. You have to ask for this one. It's almost never applied automatically. Okay, that's the tutorial level. Now let's get into the advanced gameplay, starting with discounts based on who you are and what you do for a living. This is where it gets personal. Many people don't realize that their career can save them money. Insurers collect mountains of data, and that data shows that people in certain professions are statistically safer drivers. Who's on the list? It's often engineers, scientists, teachers, first responders, doctors, nurses, and military personnel. The discount can be anywhere from 5 to 15%. If you're in one of these fields, you are leaving money on the table if you don't mention it. But it goes even deeper. Are you a member of an alumni association? A credit union? A wholesale club like Costco? Many of these organizations have affinity group partnerships with insurance companies to offer their members special rates. I once helped a guy who was a member of his university's alumni association. He hadn't thought to mention it, but that one affiliation saved him an extra 12% with a specific carrier. It was a company he never would have even quoted with otherwise. So think about every group you belong to. It could be your key to a hidden discount. Next up, let's talk about driver training. For drivers over the age of 55, California law requires insurers to offer a discount for completing a mature driver improvement course. These are state-approved courses. You can often do them online in a few hours, and the certificate is good for 3 years of savings. It's one of the easiest and most direct ways for mature drivers to lower their premiums. Now let's shift from who you are to what you drive. Your vehicle itself is a treasure trove of potential savings. The obvious ones are for safety features: airbags, anti-lock brakes, daytime running lights. Most modern cars have these, and the discounts are often baked into the vehicle's VIN-based rating. But you should always double-check they're listed. Where you can really move the needle is with anti-theft devices. If your car has a passive alarm system, one that arms itself automatically, that's a discount. If it has a vehicle recovery system like LoJack, that's an even bigger discount. The insurance company loves anything that reduces their chance of having to pay out a total loss theft claim. Are you driving a newer car? Ask for a new car discount. It sounds counterintuitive because a new car is more expensive to replace. But insurers also know that new cars have the latest safety features and are generally in better mechanical condition, making them less of a risk in some ways. This discount usually applies to cars that are 3 model years old or newer. And in a state like California, there's a big push for green vehicles. If you drive a hybrid or a fully electric vehicle, there is almost certainly a discount waiting for you. It's often called an alternative fuel or eco-friendly discount. It's the insurer's way of rewarding you for a choice that aligns with modern values and often with lower risk driving habits. Okay, so we've covered discounts for you, the driver, and for your car. Now let's talk about the easiest discounts of all. The ones you get just for how you manage your policy. I call these administrative wins. First, the paid in full discount. If you can afford to pay your entire 6-month or 1-year premium upfront instead of in monthly installments, you'll almost always get a discount. Why? Because it saves the company billing costs and eliminates the risk of you missing a payment and them having to cancel your policy. Don't want to pay it all at once? Fine. Sign up for automatic payments from your checking account or credit card. This is the electronic funds transfer or EFT discount. Again, it guarantees they get their money on time every time, and they give you a small percentage back for that convenience. While you're at it, go paperless. Agree to receive all your bills and documents electronically. That's another discount. These 3 things, paying in full, autopay, and paperless billing, can stack up to a surprising amount, and they require zero change in your driving habits. There's also the early signing or switcher discount. If you get a quote from a new company more than a week before your current policy expires and you decide to sign up, they'll often give you a discount. They're rewarding you for being organized and giving them your business early. On the flip side, there's the loyalty discount. If you stay with the same company for several years, they should be rewarding you for it. If they're not, it might be a sign that your rates have crept up and it's time to shop around. Finally, we arrive at the frontier of car insurance discounts: telematics. This is the technology that actually monitors your driving habits through a smartphone app or a small device you plug into your car. It's usage-based insurance, or UBI. Companies like Progressive with Snapshot or State Farm with DriveSafe and Save are the big players here. They track things like how many miles you drive, the time of day you drive, how hard you brake, and how fast you accelerate. Now I know what you're thinking. Big brother. And you're not wrong to be concerned about privacy. You have to decide your comfort level. But the potential savings are undeniable. If you are a genuinely safe driver, you don't speed, you don't slam on the brakes, you don't drive late at night, this technology can prove it to the insurance company in a way a simple driving record never could. The discounts can be as high as 30 or even 40% for the best drivers. It's the ultimate way to personalize your rate based on your actual real-world risk, not just the risk of your demographic. It's not for everyone, but if you're a safe, low-mileage driver, it's a potential goldmine you have to at least consider. So there you have it. The Good Driver Discount, bundling your job, your alumni group, your car's safety features, your payment method, and even your real-time driving data. We've just uncovered an entire arsenal of savings that most people simply don't know exist. It's a list of questions you need to be asking every single time you talk to an insurance agent or fill out an online form. But knowing these discounts exist is only half the battle. How do you actually deploy them? How do you make sure that every single one you qualify for is being applied when you get a quote? Because I can promise you they won't always be added automatically. That process, the art of extracting the absolute best price during the quoting stage, is the critical next step. And it's where most people drop the ball. So let's pick up that ball and run with it. The quoting process isn't just data entry. It's a strategic game, and the insurance company's website is the game board. Every box you check, every number you enter, is a move that can either save you hundreds of dollars or cost you a fortune. Your first move is the easiest, but it's foundational. Your personal information. Name, address, date of birth. Simple, right? But this is where the first seed of doubt creeps in for people. They see these fields and they think, are they going to run my credit? Is this going to hurt my score? Let's clear this up right now. In California, insurance companies use something called an insurance score, which is partly derived from your credit history. But, and this is the critical part, when you're getting a quote, they are only doing a soft pull. A soft pull does not affect your credit score in any way. It's the same kind of inquiry that happens when a credit card company sends you a pre-approved offer in the mail. So breathe easy. Providing your real information here is not only safe, it's essential. Your address, for example, is one of the biggest factors in your rate. It determines your garaging location, which tells the insurer everything about the theft rates, accident frequency, and repair costs in your specific neighborhood. Using a friend's address in a cheaper zip code might seem clever, but it's also insurance fraud. And it's the kind of thing that will get your claim denied and your policy canceled the second they find out. And trust me, after an accident, they will find out. Next up, your vehicle. You'll see drop-down menus for the year, make, and model. Ignore them. This is the first amateur mistake. Do not guess your car's trim level. Do you have the LX, the EX, the EXL, the Touring, the Sport? Do you know for a fact if your specific model came with standard anti-lock brakes in that production year? Or if it has a passive anti-theft system? Most people don't. And guessing is like leaving a pile of cash on the table. There is only one correct way to do this. Use the VIN, the Vehicle Identification Number. It's on your registration, your current insurance card, and on a little plate on your dashboard visible through the windshield. The VIN is your car's unique fingerprint. When you enter the VIN into the quoting system, it doesn't just pull the make and model. It pulls the exact specifications of the car that rolled off the assembly line. It knows the engine size, the trim package, the exact number of airbags, the type of braking system, the specific anti-theft technology installed at the factory. All of these are potential discounts. I once helped a friend who was sure he drove a base model Honda Accord. He'd been getting quotes for years based on that. When we plugged in his VIN, it turned out he had a higher trim level that included a sophisticated factory alarm and additional safety features he didn't even know about. The system automatically applied 2 discounts he'd been missing for 5 years. His premium dropped by 17%. Instantly. The VIN is non-negotiable. Use it every single time. Now for the drivers. This is where it gets personal and where precision is paramount. You'll list everyone in your household of driving age. Be honest here. Forgetting to list your 16-year-old son who just got his permit is, again, a fantastic way to have a claim denied. They'll ask for your marital status. This isn't them being nosy. Decades of data show that, on average, married individuals are involved in fewer and less severe accidents than single individuals. It's a risk calculation, plain and simple. Being married can often result in a significant discount. Then you get to occupation and education level. A lot of people see this and think, what does my job have to do with my driving? They'll just select other or leave it blank. Huge mistake. This is a goldmine for hidden discounts. Insurers have identified certain professions that correlate with lower risk driving behavior. Are you a teacher? There's a discount for that. An engineer? Discount. A scientist? Discount. A nurse or first responder? Often there's a discount for that too. The same goes for your education level. A bachelor's degree, a master's, or a PhD can each unlock a new tier of savings. The system won't guess this for you. You have to tell it. Next, you'll be asked for your annual mileage. This has become one of the most important rating factors, especially in the age of remote work. Do not just guess 12,000 miles because it sounds like a standard number. That's what everyone does. Be a sniper. Calculate it. Figure out your daily round-trip commute. Let's say it's 20 miles. Multiply that by the number of days you work a week, say 5, that's 100 miles. Multiply that by the number of weeks you work a year, let's say 50. That's 5,000 miles. Now add in your weekend and errand driving. Maybe you average 50 miles a week on weekends. 50 times 52 weeks is 2,600 miles. Add a buffer for a road trip or two, maybe another 1,500 miles. So your total is 9,100 miles. By entering that precise, lower number instead of the generic 12,000, you could trigger a significant low mileage discount. If you work from home, your mileage might be under 5,000. That can lead to massive savings. Be honest, but be accurate. Okay, deep breath. Now we get to the part that makes everyone nervous: driving history. Accidents, tickets, claims from the past 3 to 5 years. My advice here is brutally simple. Tell the absolute, unvarnished truth. Do not lie. Do not omit. Do not fudge the dates. Why? Because they already know. Before they give you a final, bindable quote, every insurance company is going to pull 2 reports. The first is your motor vehicle report, or MVR, directly from the California DMV. Every ticket, every violation, it's all there. The second, and the one most people don't know about, is called a CLUE report. CLUE stands for Comprehensive Loss Underwriting Exchange. Think of it as the credit report for your insurance history. Every auto or home insurance claim you've ever filed with any company is logged in this database. So if you had a fender bender 2 years ago that you filed a claim for, but you forget to mention it on your quote application, the system will give you a beautiful low teaser rate. You'll get excited. You'll enter your credit card number. And then a day or two later you'll get an email, an updated declaration. Your premium has shot up by 40%. Why? Because their underwriting department pulled your MVR and CLUE reports and adjusted the rate to reflect reality. Lying here doesn't save you money. It just wastes your time and gives you a false sense of what you're going to pay. Be upfront, and the quote you get will be the price you actually pay. Finally, we arrive at the treasure hunt, the discounts page. This is almost never a single page. The discounts are often sprinkled throughout the quoting process, and you have to have a keen eye. You are looking for every last dollar. First, the obvious one: bundling your auto with renters or homeowners insurance. This is usually the single biggest discount you can get, often between 10 and 25%. Next, good student discount. If you or a driver on your policy is in high school or a full-time college student under the age of 25 with a B average or a 3.0 GPA, that's a huge discount. Have the transcript ready to prove it. Defensive driving course. For a small fee and a few hours of your time, an approved online defensive driving course can knock a percentage off your premium for 3 straight years. The math on this almost always works out in your favor. Now for the one almost everyone misses: affinity groups. Are you a member of a credit union like Navy Federal? Are you a member of an alumni association? A professional organization for engineers or accountants? Do you have a warehouse club membership like Costco? All of these groups often have partnership deals with insurance companies that unlock special, discounted rates you cannot get anywhere else. Go through your wallet and your memberships. Make a list. It's free money. Look for the small stuff too. Paperless billing discount, automatic payments or EFT discount, paid in full discount. This one can be big. If you can afford to pay your 6-month premium all at once instead of in monthly installments, you can often avoid service fees and get a sizable discount on top of that. And last, there's the controversial one, telematics. This is where you agree to use a smartphone app or plug a small device into your car that monitors your driving habits. Things like hard braking, rapid acceleration, late-night driving, and phone use. Programs like Progressive Snapshot or State Farm's Drive Safe and Save. If you are a genuinely safe, conservative driver, these programs can save you up to 30%. But be warned, if you're not, it can actually raise your rates with some companies. It's a calculated risk, but one worth considering if you're confident in your driving. By now, you've built a quote that is a true, accurate reflection of your risk, and is packed with every single discount you rightfully deserve. You've gone from a generic estimate to a hardened rock-solid number. But this is just one quote from one company. The real power comes from taking this exact same meticulously crafted profile and using it to get quotes from multiple carriers. And that's where the next crucial phase begins. Comparison. Because not all quotes are created equal, and the cheapest price on the screen can hide a very expensive secret. That secret is the difference between a policy that truly protects you and a piece of paper that just makes you legal. It's the difference between walking away from an accident financially whole and having your entire world turned upside down by a single fender bender. Welcome to the most critical step in this entire process, dissecting your quotes. Because the number you see on the screen, that tempting low monthly premium, is often a master of disguise. Let's imagine two drivers, both in California, both with identical driving records and cars. Let's call them Alex and Sarah. They both go online, fill out their profiles perfectly, and get a list of quotes. Alex sees a quote from a company we'll call Barebones Auto for $89 a month. He sees another from Fortress Insurance for $125. He thinks, it's a no-brainer. Why would I pay $36 more for the same thing? He clicks buy on the $89 policy and feels proud of the deal he just got. Sarah sees the same quotes, but instead of jumping on the lowest price, she clicks view details. And what she finds is the reason we're having this conversation. She's not just comparing prices, she's comparing promises. An insurance policy is a bundle of promises from a company, and you need to know exactly what they're promising you for your money. The first and most important promise is your liability coverage. This isn't for you. It's for the people you might injure or the property you might damage in an at-fault accident. California has a state minimum requirement, which is often abbreviated as 15/30/5. This is what Alex bought. It sounds official, but let's break down what it actually means. It means his policy will pay a maximum of $15,000 for bodily injury to one person, a maximum of $30,000 for bodily injury for the entire accident if multiple people are hurt, and a pathetic $5,000 for property damage. $5,000. Think about that for a second. When was the last time you saw a new car on the road that costs less than $5,000? You could lightly tap the bumper of a new Honda Civic and cause more than $5,000 in damage with all the sensors and cameras they have now. What if you hit a Tesla, a BMW, a Ford F-150? That $5,000 is gone in an instant. And who pays the rest? You do. Out of your pocket. Let's say Alex causes a chain reaction on the 405. He rear-ends a Toyota Camry, which then bumps into a Lexus SUV. The Camry has $7,000 in damage. The Lexus has $12,000. That's $19,000 in total property damage. Alex's policy covers $5,000. He is now personally on the hook for the remaining $14,000. The other drivers' insurance companies will pay to fix their clients' cars, and then their lawyers will come after Alex personally to get that money back. They can go after his savings, his assets, and even garnish his future wages until that $14,000 is paid off. And that's just the cars. What if one of the drivers has whiplash and needs physical therapy? His policy covers a maximum of $15,000 for that one person's medical bills. In today's healthcare system, a single ambulance ride and an ER visit can eat up that entire amount. If their bills exceed $15,000, he's on the hook for that too. His $89 a month deal has just led him to the brink of financial ruin. Now let's look at Sarah's quote. She saw that the $125 policy from Fortress Insurance offered liability limits of $100,000/$300,000/50, $100,000 for a single person's injuries, $300,000 total for the accident, and $50,000 for property damage. In the exact same accident, her policy would have covered all the car repairs and had plenty of room for medical bills. For an extra $36 a month, she bought herself a fortress of financial protection. She bought peace of mind. The number one rule of comparing quotes is this: never, ever settle for state minimum liability unless you have absolutely no assets to your name and no future income to protect. It is a catastrophic financial gamble. Next, let's look at the deductibles. This is the amount of money you have to pay out of pocket before your insurance kicks in to repair your car. This applies to your collision coverage, which fixes your car after an accident, and your comprehensive coverage, which covers theft, vandalism, or hitting a deer. A higher deductible means a lower monthly premium. Alex, in his quest for the lowest price, chose a $2,000 deductible. Saved him about $15 a month. A few weeks later, his car is hit in a parking lot, and the other driver speeds off. The body shop quotes the repair at $3,500. To get his car fixed, Alex has to write a check for $2,000 right then and there. Like most people, he doesn't have $2,000 just sitting around for an emergency. So his car sits, damaged and undrivable, while he scrambles to come up with the money. Sarah, on the other hand, chose a $500 deductible. Her premium was slightly higher, but she knew she could comfortably afford to pay $500 on a moment's notice. When the same thing happens to her, she pays her $500, and her insurance covers the remaining $3,000. Her car is back on the road in a week. Her life is barely disrupted. When you look at your deductible options, ask yourself one simple question. Could I write a check for this amount tomorrow without panicking? If the answer is no, your deductible is too high. Don't trade a few dollars a month in savings for a massive, unaffordable bill when you need your car the most. Finally, we need to talk about the coverages that are often listed as optional, but for most Californians are absolutely essential. The most important of these is uninsured and underinsured motorist coverage, or UM/UIM. This is coverage that protects you when you are hit by someone who has no insurance or not enough insurance. And in California, this is a massive problem. Estimates show that 1 in every 7 drivers on California roads is uninsured. That's a terrifying statistic. Let's go back to Alex. He declined UM/UIM coverage to save another $8 a month. One day, he's sitting at a red light and gets rear-ended by a driver who then speeds off. It's a clear hit and run. Alex has neck pain and his car is damaged. But since the other driver is gone and can't be found, he's treated as uninsured. Because Alex has no UM coverage, his own insurance company can't help him with his medical bills. He has to use his own health insurance, pay those deductibles, and hope for the best. And to fix his car, he has to file a claim on his own collision coverage and pay that massive $2,000 deductible. He was the victim, but he's the one paying for everything. Sarah, of course, paid for UM/UIM. In the same situation, her own insurance company steps in. They act as the insurance the other driver should have had. They cover her medical bills, her lost wages if she can't work, and they pay for her car repairs. She still has to pay her deductible, but it's her manageable $500 one. She is made whole because she had the foresight to protect herself from the irresponsibility of others. The same logic applies to other small but powerful add-ons like rental reimbursement. This typically costs a few extra dollars a month, maybe 5 or 6. It provides you with a rental car while yours is in the shop after a covered claim. Alex's car is in the shop for 2 weeks. He has no rental coverage. He's spending $40 or $50 a day on Ubers just to get to work and back. That's $500 over 2 weeks. All because he wanted to save $5 a month. Sarah's policy covers a rental car. Her life goes on as normal. So when you lay your quotes side by side, you're not just looking at a price. You're looking at a complete picture of your financial safety net. The $89 policy wasn't a deal. It was a trap. It was a hollowed-out policy that offered the illusion of security, while leaving Alex exposed to tens of thousands of dollars in potential debt. Sarah's $125 policy wasn't an expense. It was an investment in stability. The goal is not to find the cheapest piece of paper that satisfies the DMV. The goal is to find the best possible value, the most robust protection you can comfortably afford. Look past that big monthly number. Scrutinize the liability limits. Choose a deductible you can actually pay. And never, ever skimp on protecting yourself from the massive risk of uninsured drivers. By comparing these core components, you transform from a price shopper into a value hunter. And that's how you find a policy that doesn't just give you a good deal, but gives you true, unshakable peace of mind. Now, once you've compared apples to apples and found a few high-value options, there's another layer we need to peel back: the company itself. Because a policy is just a piece of paper, a promise. The real question is, who is making that promise? Is it a company with a rock-solid reputation for keeping their word? Or is it a company known for finding loopholes to break it? The difference between the two isn't just a few dollars a month. It's the difference between a minor inconvenience and a life-altering financial catastrophe. Let me tell you a story about a guy named David. David is smart. He's a software engineer, he's financially savvy, and he loves finding a good deal. When his car insurance came up for renewal, he did what we all do. He went online to shop for quotes. He got a quote from his current well-known insurer for about $150 a month. Then he got quotes from a few other big names, all in the same ballpark. But then he found one. A company he'd vaguely heard of. Let's call them Apex Advantage Insurance. Their quote? $95 a month. For the exact same coverage. David felt like he'd cracked the code. He thought, these big companies are just ripping me off with their massive advertising budgets. I'm paying for their celebrity spokespeople and their blimps at football games. This smaller company is lean and mean, passing the savings on to me. He double-checked the coverage limits. They matched perfectly. He clicked buy, entered his credit card info, and felt a wave of satisfaction as he saved over $600 a year. For 8 months, everything was perfect. He was a genius. That $600 was in his pocket, not theirs. Then came a Tuesday afternoon. He was stopped at a red light on a busy street, listening to a podcast when bam, a distracted driver in a huge pickup truck slammed into him from behind. The back of his new sedan was completely crumpled. David was shaken up, but thankfully not seriously injured. Annoying, but hey, that's what insurance is for, right? He called Apex Advantage from the side of the road. First, he navigated an automated phone tree from hell for 15 minutes before finally reaching a human. The agent on the other end sounded bored and unenthusiastic. David explained what happened, gave the other drivers information, and asked what to do next. The agent told him to submit the claim through the online portal, and that an adjuster would be in touch within 3 to 5 business days. 3 to 5 business days? His car was barely drivable. But okay, he did as he was told. He went home, uploaded the photos, the police report, and a description of the accident to their clunky, outdated website. 5 business days went by. Nothing. He called back. After another 20 minutes on hold, a new agent told him the claim had been assigned, but the adjuster was experiencing high call volumes. They promised the adjuster, a guy named Frank, would call him by the end of the day. Frank never called. The next day, David called again, this time specifically asking for Frank. He was sent to a voicemail box that was, of course, full. This went on for a week. He was leaving messages, sending emails into a black hole, and getting more and more frustrated. Meanwhile, he was forced to pay for a rental car out of his own pocket because Apex Advantage wouldn't approve it until the adjuster had officially inspected the vehicle and determined liability, even though he was rear-ended at a red light. A textbook non-fault accident. Finally, in week 3, he gets a call from Frank. There's no apology for the delay. Frank speaks in a monotone, telling David that the initial photo estimate for the repair is $4,000. David had already taken the car to his trusted body shop, which quoted him over $9,000 for a proper repair using original manufacturer, or OEM, parts. Frank scoffed. He said the Apex Advantage estimate was based on using aftermarket and salvaged parts, and that they wouldn't pay a penny more. He told David, "If your shop wants to charge you more, that's between you and them." David was floored. He was paying for a premium service that promised to restore his car to its pre-accident condition. Instead, he was being told to put junk parts on his 2-year-old car or pay $5,000 out of his own pocket. He spent the next month fighting. Hours on the phone. Dozens of emails. He filed a complaint with the Department of Insurance. The stress was immense. He wasn't sleeping. It was affecting his work. That $55 a month he saved? It was the most expensive money he ever saved in his life. He would have paid triple his old premium just to have a competent, professional company handle this for him. David's story isn't an exaggeration. It happens every single day. The price you pay for your premium is only one part of the cost of insurance. The true cost is revealed in your darkest hour, when you actually need to use it. So, how do you avoid becoming David? How do you look past the tempting price tag and evaluate the company behind the promise? You become a detective. And luckily, the clues are all publicly available. There are 4 key areas you need to investigate. First, and most importantly for us here in California, is the state's official report card. The California Department of Insurance, or CDI, publishes an annual consumer complaint study. This isn't based on feelings or Yelp reviews. It's hard data. It shows the number of justified complaints filed against each insurance company, and then it turns that into a complaint ratio. This ratio tells you how many complaints a company gets for every 100,000 policies they have in the state. This is the single most powerful tool you have. It lets you compare a giant company to a small one on a level playing field. A low complaint ratio is a massive green flag. A high one? It's a blaring siren telling you to run in the other direction, no matter how cheap their quote is. Second, you need to check their financial strength. An insurance company is only as good as its ability to pay its claims. If a massive earthquake or wildfire hits and your insurer goes bankrupt, your policy is worthless. You need to know they have the cash to cover you. You don't need to be a Wall Street analyst to figure this out. Independent agencies like AM Best, Moody's, and Standard & Poor's do the work for you. They give insurance companies a grade just like in school. You're looking for companies with an A rating like A-, A, or A+. This signifies that the company has an excellent ability to meet its financial obligations. If you see a company with a B, or heaven forbid a C rating, it doesn't matter if they offer you free insurance for life. It's a gamble you can't afford to take. Third, look at nationwide customer satisfaction surveys. The gold standard here is J.D. Power. Every year, they release their U.S. auto insurance studies. They survey tens of thousands of actual customers and rank companies on everything from the initial purchase experience and billing to, most critically, the claims process. They break it down by region so you can see exactly how companies perform right here in California. A company that consistently ranks at the top of the J.D. Power study is one that invests in its customer experience. They understand that a smooth, empathetic claims process is the best marketing they can have. Finally, after you've looked at the official data, it's time to look for patterns in the anecdotal evidence. Go to the Better Business Bureau website. Sift through forums on Reddit, but do it with a critical eye. Remember, angry people are always the loudest. For every one person who posts about a bad experience, there are 1,000 satisfied customers who never say a word. So don't let a single horror story scare you away. Instead, look for patterns. Is everyone complaining about the same thing? Slow claims payouts? Rude adjusters? Lowball repair estimates? If you see dozens of different people on different platforms over a period of months or years, all describing a nightmare scenario just like David's, you're not just seeing a one-off problem. You're seeing the company's culture. You're seeing how they systemically treat their customers when things go wrong. Putting it all together, you create a complete picture. You find a company with a low complaint ratio from the state of California, an A rating for financial strength, high marks from J.D. Power, and no overwhelming pattern of online complaints. A company that checks all 4 of these boxes is a company that values its reputation and its customers. They might be a few dollars more per month than the Apex Advantage of the world, but what you're buying isn't just a policy. It's a guarantee of competence. It's an assurance that when that terrible Tuesday afternoon happens to you, the voice on the other end of the line will be there to help, not to fight you. You're buying peace of mind, and that is always worth the price. Now that you know how to find a quality company, the next step is to make sure you're not leaving any money on the table. The insurance world is filled with discounts, but most people only know about the common ones. California, however, has some very specific and very powerful ways to cut your bill that your insurer might not be so quick to advertise. We're going to uncover those hidden gems. First on the list, and by far the most powerful tool in your arsenal, is the California Good Driver Discount. This isn't just a friendly little bonus your insurer might offer you. It is a state-mandated, legally required discount of at least 20%. Let me repeat that. If you qualify, your insurance company is required by law to give you a discount of at least 20% off your premium. This isn't a maybe. It's a must. And under California's Proposition 103, your driving record is legally the #1 factor they must use to set your price. Not your zip code, not your credit score, your driving record. So, securing this discount is the absolute foundation of getting a fair rate in this state. So what does it take to be an official good driver in the eyes of the law? It's surprisingly straightforward. You need to meet 3 simple criteria. First, you need to have been continuously licensed to drive for the past 3 years. This can be a license from any state or even another country, as long as there were no significant gaps. If you're a brand new driver, you'll have to wait until you hit that 3-year mark, but the second you do, you need to be on the phone with your insurer. Second, in the last 3 years, you cannot have more than 1 point on your driving record. Now, this is where people get confused. What counts as a point? A typical speeding ticket or an at-fault accident where someone was injured or the damage was over $1,000 will usually get you 1 point. Getting a DUI or a reckless driving charge is a major violation and will instantly disqualify you. But here's a pro tip. Not all tickets carry a point. A parking ticket? 0 points. A cell phone ticket? As of 2021, a first offense no longer adds a point to your record. And if you do get a minor moving violation, you may be eligible for traffic school. If you complete it, the DMV will mask the point from your insurance company, and it's like it never happened. It is always worth it to elect for traffic school if you're eligible. It could save you hundreds, if not thousands, of dollars over the next 3 years by preserving your good driver discount. The third and final requirement is that you weren't principally at fault for an accident that resulted in serious injury or death within the past 10 years. For the vast majority of drivers, this is an easy box to check. So, license for 3 years, 1 point or less in the last 3 years, and no major at-fault accidents in the last 10. That's it. If you meet these criteria, you are legally entitled to that 20% discount. Don't just assume your insurance company has applied it. When you're shopping, ask them directly. Based on my record, do I qualify for the statutory California Good Driver discount? Use that exact phrase. It shows you know the law. If they say no, demand a specific reason that references one of those 3 legal requirements. This single discount is the biggest lever you can pull to lower your premium. Next up is a discount that has become increasingly powerful in our post-pandemic world of remote work and changing commutes. The low mileage discount. California law requires insurers to offer a discount to drivers who stay under a certain number of miles each year. The exact mileage threshold and the discount amount vary by company, but it can be substantial. Some insurers offer their best rates to people driving under 7,500 miles a year, while others might set the bar at 10,000 or 12,000 miles. Think about your driving habits right now. Are you still driving to the office 5 days a week? Or are you working from home 2 or 3 days? Did you switch to a job that's closer to home? That change in your routine could be an untapped goldmine. When you first signed up for your policy, you gave them an estimated annual mileage. If that number has dropped significantly, you are likely overpaying. You need to update that information. This is also where those telematics programs, the little plug-in devices or smartphone apps that track your driving, come into play. Companies like Progressive with Snapshot or State Farm with DriveSafe and Save heavily push these. They sell it as a way to prove you're a safe driver. And while they do track things like hard braking and late-night driving, one of the biggest factors they measure is mileage. If you are a legitimate low-mileage driver, these programs can be a fantastic way to prove it and lock in a deep discount. However, a word of caution. If you're a high-mileage driver or have a bit of a lead foot, these programs can backfire and potentially even raise your rates. It's a trade-off. You're trading some of your privacy for a potential discount. If you're confident in your low mileage and safe habits, it can be worth it. If you'd rather not have your insurer looking over your shoulder, you can simply self-report your estimated mileage. Just be honest. If you claim you drive 5,000 miles a year but get into an accident 300 miles from home 2 months into your policy, they're going to ask questions. Now let's talk about discounts you might already qualify for without even realizing it. These are affinity and group discounts. Insurance companies love to partner with large organizations, employers, universities, professional associations, even wholesale clubs like Costco, to offer special rates to their members. Are you a member of an alumni association? Did you graduate from a specific university? Are you a teacher, an engineer, a nurse, a first responder, or a government employee? Are you a veteran or active duty military? All of these groups often have negotiated discounts with major insurance carriers. We're not talking about 1 or 2%. These can be significant, sometimes 5, 10, or even 15%. The key is you have to ask. Your agent isn't going to go through a checklist of every possible organization you might belong to. You need to be proactive. When you're getting a quote, make a mental list of all your affiliations. Think about your job, your education, any professional licenses you hold, any clubs or societies you're a part of. Then ask the magic question. Do you offer any discounts for members of your organization? You might be shocked at the answer. It's essentially free money, a discount you've earned simply by being you. Don't leave it on the table. For our more experienced drivers, there's another fantastic and often overlooked discount. It's called the mature driver discount. In California, if you are 55 or older, you can take a state-approved mature driver improvement course, and upon completion, your insurance company is legally required to give you a multi-year discount. These aren't the boring all-day classroom courses you might remember. Most are now available online. You can do them at your own pace from the comfort of your couch. They typically cost between $20 and $40, but the discount you receive will pay for the course many times over during the 3 years it's valid. It's a small investment of time and money for a guaranteed return. It's one of the easiest, most straightforward ways for drivers in that age bracket to immediately lower their insurance costs. Finally, while we're uncovering hidden gems, let's not forget the basics that people often miss. The good student discount is a big one. If you have a high school or college student on your policy who maintains a B average or better, that can shave a serious amount off your premium. You'll need to provide proof like a report card or transcript, but the savings are well worth the effort. And of course, there's the multi-policy discount, which you've probably heard of. Bundling your auto insurance with your homeowner's or renter's insurance. This is almost always a good deal. But here's the advanced tactic. Don't just assume your current home or renter's insurance company will give you the best bundle price. You should shop for the bundle as a package deal from multiple companies. Company A might be cheapest for your auto insurance alone, but Company B might offer such a massive bundling discount that their combined auto and home package ends up saving you hundreds of dollars more. Always quote the package. These discounts, good driver, low mileage, affinity groups, mature driver, and the others are not just minor perks. They are the building blocks of an affordable policy in California. They are your legal rights and your earned rewards. Knowing about them is one thing, but actively pursuing them, asking for them by name, and proving you qualify, that's how you take control of the game. That's how you stop paying for the average driver and start paying a rate that reflects you. But even with all these discounts, there's still one final crucial step in the process. And that final step is the one that separates the rookies from the pros. It's the move that takes all the knowledge we've built over this entire series, all the understanding of liability, collision, comprehensive, MedPay, all the discount hunting, and turns it into cold hard cash back in your pocket. That final, crucial step is the championship game of car insurance. You have to make the companies compete for your business. You have to comparison shop. I know. Sounds like a chore. Sounds tedious. But I need you to reframe that in your mind right now. Comparison shopping isn't a chore. It's a power move. It is the single most effective strategy for slashing your insurance premium, often by hundreds, sometimes even over $1,000 a year. Why? Because the car insurance market is brutally competitive, but it relies on one simple human behavior: inertia. Insurers know that once a customer signs up, they're likely to stay for years, even as their rates slowly creep up. They call it the loyalty tax, and it's a very real thing. The company you've been with for a decade, the one sending you holiday cards, they might be charging you 20, 30, even 40% more than a competitor would for the exact same coverage, simply because they bank on you not checking. Proving your loyalty gets you a small discount. Proving you're willing to walk away gets you the market's absolute best price. So how do we do it? How do we execute this game-winning play? There are fundamentally 3 ways to shop for quotes, and you need to understand the pros and cons of each. First, you have the direct-to-carrier approach. This is you, on your computer, going directly to the websites of companies like Geico, Progressive, Esurance, or any of the big names you see on TV. The advantage here is total control. You're inputting the data yourself, you see the options directly from the source, and there's no middleman. The massive disadvantage is the time. To get a true sense of the market, you need to quote with at least 5 to 7 different companies. That means filling out your name, address, date of birth, VIN number, driving history, and coverage selections 5 to 7 separate times. It's repetitive, it's draining, and it's easy to make a mistake on one of the forms, which throws off the whole comparison. Second, you have the captive agent model. This is your classic neighborhood agent who works for one, and only one company, think State Farm or Farmers Insurance. The upside is that these agents often know their company's products inside and out. They can be a great resource for understanding complex policies and finding every last discount within their own system. The glaring downside is right in the name. They are captive. They cannot legally and ethically tell you that a competitor down the street is offering a better deal for half the price. Their goal is to sell you their product, period. It's like asking a Ford salesman if you should buy a Toyota. You already know the answer you're going to get. Third, and this is often the sweet spot for many people, you have independent agents and brokers. These individuals are free agents. They aren't employed by a single insurance company. Instead, they have appointments to represent multiple different carriers. Their job is to take your information once and then go out and shop the market for you. This saves you a tremendous amount of time. A good independent agent can bring you back 3, 4, or 5 quotes from different companies, lay them out side by side, and help you choose. The potential downside? They don't represent every company. Big direct-to-consumer players like Geico don't use them. And you have to be aware that they are paid on commission. So it's important to find a reputable broker who prioritizes your needs over their paycheck. So which path do you choose? Honestly, for maximum savings, a hybrid approach is best. Use an independent agent to get a baseline of quotes from the companies they represent, and then take 10 minutes to get your own direct quote from a major player like Progressive or Geico to see if they can beat it. This gives you the best of both worlds. Now, as you start seeing these numbers, these quotes come in, you have to be incredibly careful. This is where most people make a critical mistake. You must ensure you are comparing apples to apples. A quote that's $100 cheaper is worthless if it has a massive deductible or dangerously low liability limits. Print out each quote, put them side by side, and go down the line item by item. Are the bodily injury liability limits identical? 100/300/100 on one, 100/300/100 on the other? Are the deductibles for collision and comprehensive both exactly $500? Is rental car reimbursement included on both? And for the same amount per day? Is the good driver discount applied on all of them? One small difference can make a quote seem cheaper when in reality you're just buying less protection. Don't fall for it. Once you have your true apples-to-apples comparison, and you've identified the top 2 or 3 contenders based on price, the final decision isn't just about the number. A cheap policy from a terrible company is one of the worst financial decisions you can make. The moment you need them, the moment you're standing on the side of the road after a crash, is not the time to find out your insurer is famous for denying claims and giving customers the runaround. So you need to do a final quick background check. There are 2 key metrics to look at. First, search for the company's NAIC Complaint Index. The National Association of Insurance Commissioners tracks consumer complaints. The baseline score is 1.0. A company with a score of 2.0 has twice as many complaints as expected for its size. A company with a 0.5 has half as many. Stick with companies at or below 1.0. Second, look up their customer satisfaction ratings from a reputable source like J.D. Power. These surveys rank companies on their overall performance, especially their claims process. A company that's consistently at the top of these rankings is likely a safe bet. Saving $10 a month means nothing if you have to spend 40 hours on the phone fighting with a claims adjuster to get your car fixed. Price is what you pay today, but service is the value you get when everything goes wrong. Okay, you've done it. You've understood the coverage, you've gathered your documents, you've hunted down every discount, you've compared multiple quotes apples to apples, and you've vetted the company's reputation. You have found the winner. Now, how do you make the switch without creating a dangerous lapse in coverage? This part is critical. Step 1. Purchase the new policy. Do not cancel your old one yet. Sign the new application, make the first payment, and set the effective date for your new policy. It can be today, it can be tomorrow, whatever you choose. Step 2. Wait until you have proof of the new insurance in your hand, or at least in your email inbox. You want the official ID cards and the policy declaration page. Step 3. And only now, after the new policy is officially active, do you contact your old insurance company to cancel. Tell them you want to cancel effective the same day your new policy began. This ensures there is zero gap in coverage. A single day of lapsed coverage can trigger a notification to the California DMV and can be a huge red flag that jacks up your rates in the future. Overlap is okay, a gap is not. Your old company will then owe you a prorated refund for any unused premium you had paid. And that's it. That is the entire process. From a place of confusion and frustration, just accepting whatever bill came in the mail, to a position of absolute power and control. You are now the expert. You understand that insurance isn't just a piece of paper. It's a financial shield that protects you, your family, and your future from catastrophe. You know how to customize that shield, reinforcing it where you need it most while trimming away the parts you don't. You know how to demand to be treated as an individual, not as an average, and to be rewarded for your good habits with every discount you've earned. And most importantly, you know how to walk into the marketplace not as a price taker, but as a price maker, forcing companies to fight for the privilege of protecting you. You've taken the keys, not just to your car but to this entire process. You now have the knowledge to save yourself thousands of dollars over your lifetime, money that you can use to pay off debt, invest for the future, or spend on things you actually enjoy. You've turned a necessary evil into a mastered skill. Now go use it. Build your financial fortress one smart decision at a time.